You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Dana Peterson, Chief Economist and leader of the Economy, Strategy, and Finance Center at the Conference Board, and also guest host of today's episode. Joining me today is Stephanie Guichard, Senior Economist of Global Indicators, and Erik Lundh, Senior Global Economist. In today's conversation, we'll discuss the latest Consumer Confidence Index, as well as our outlook for the global economy. Welcome, Stephanie and Erik.
Good morning.
Good to be here.
Good morning to you both. And I'm glad to be here as well. All right, let's start with you, Stephanie. We had the release of the May Consumer Confidence Measure. April was pretty bad. So after several months of flagging confidence, how are consumers feeling in May?
So in May, consumers are feeling better than in April and even in March. So we saw a partial rebound in consumer confidence overall, and the index regained some of the ground it had lost in the previous month.
That's excellent. But we're still not back where we were earlier this year, right?
No, we are still below the February level. It's better than April and March, but not yet as good as in February, and really not as good as it was at the peak, which was in November.
Okay, so it sounds like consumers are still worried.
Yes.
Did the survey reflect any concerns related to tariffs or financial market gyrations?
So when we ask consumers what is driving their view of the economy, we see that tariffs is on top of mind for consumers. So yes, it's really affecting consumer views of the economy right now. We run this survey through early May until around the 20th of May. So in the middle, we had a deal with China that resulted in the pause on some of the tariffs. So what we did, we looked at consumer confidence before and after this trade deal. And obviously, we saw a much stronger improvement in consumer confidence after the May deal. So it clearly seemed to have an impact especially on consumers' expectations. So they felt less anxious about the future after the May deal.
It also seemed like financial markets also had a rally. Do you think that affected how consumers felt?
Yes, most likely. We see that stock market is for consumers an indication of where business conditions are going. It's an indication of potentially future income for them, since some of them receive income from stocks. So it's really one of the input into how they form their expectation about the economy, but also how they feel the economy is doing right now. They just look at the stock market and they hear the news every day. So what we saw after May 12 was really some improvement in how consumers who are thinking about the stock prices. And if you remember, in March and April, overall consumers were negative about the future of the stock market. We had more consumers thinking it was going to decline than thinking it was going to improve. But this moved back into positive territory in May. So clearly, consumers saw the stock market improving. They changed their view about the stock market going forward, and it also affected their views about business conditions and potentially future income.
Yes, and also, right or wrong, consumers look at the stock market as a proxy for their employment in the future. Again, because they're looking at businesses, and if the stock market's not doing well and businesses aren't doing well, they assume that maybe they're about to see a pink slip. All right, so are consumers still anticipating a recession within the next 12 months in the survey?
They still do, but it's a bit less than in the previous 2 months, so a bit less than in May, than in March or April. But I would say it's a higher share than it was in 2024. So we are not back to the good numbers we had a year ago. This series is quite short. We started to ask the questions only a few years ago, so we don't have the whole history. We don't know how low it could go. But overall, so far, I would say it's still not out of the woods in terms of consumers' expectations for a forthcoming recession.
Okay. So, what's the overall message consumers are telling us about the second half of this year?
I think for the second half of this year, currently they are still anxious about the future. So they are telling us they're going to be paying a lot of attention of what's happening in the economy going forward. So far, they still have jobs, but they are worried that the job market is going to deteriorate in the next 6 months. So they're going to be very careful, I think, and they're going to pay attention to all this economic data, and they're going to be paying attention on what's happening on the tariff fronts and some positive development. Most likely, what we saw this month is going to persist going forward. If we see some no trade deals, tariffs coming back, some the ones that were postponed, most likely this is going to go in the other direction. So basically, they're going to pay attention to economic policy, the economy in general, and this is going to affect how they behave in the next 6 months.
Okay. Let's dive a little bit more deeply into the details. Was it the present situation or expectations that drove changes in the overall measure?
So it was both measure improved, but it's really the expectation index that improved. And so let's say consumer were extremely pessimistic in April, and now they are just pessimistic overall.
Okay.
Yeah.
Okay. What in particular drove the expectations gauge? 'Cause I know that there are three series that underpin that measure.
Yeah, so we have the three components of the expectation gauge improved. So it's the good news because you want this some kind of broad-based improvement in the data. We had some improvement in the expectations for business conditions. We had some improvement in expectations for the labor market going forward, but these two are still in pessimistic territory. The one that moved, not necessarily the most, but that moved back into positive territory is income expectation. And this is one that we look at very carefully because if consumers are pessimistic about their future income, this is where we could see a shift, more important in terms of spending going forward. So they were pessimistic in April, but they moved back into being slightly optimistic in May. So that's really good news.
So, given these changes, do consumers have greater or fewer concerns about their finances? And finances are a function of working income, but also transfer payments and dividends and interest and all those good things.
So overall, we have two measures of financial situation. One is related to the current situation, and the other one is related to the expectation going forward. They both improved in May, and they improved clearly. I think April was the bottom for both present and future, and we saw a substantial rebound. In the month of May, we are still not back to the height we had at the end of last year, but it has definitively improved.
That's good. So, are consumers still also very focused on inflation and prices?
Yes, after tariffs, prices are one of the dominant themes in the writing responses when we ask consumers what is affecting their views of the economy. And we also have a question of inflation expectations. The measure reached like a short-term peak last month where consumers were expecting inflation at 7% in the next 12 months. Now it has slowed a little bit to 6.5%, but we are still much higher than we were in November last year, where inflation expectations were at 5%. So yes, consumers are concerned about prices. They have revised up their inflation expectations compared to 6 months ago. Also, I would like to add, we asked consumers if they were worried about not being able to afford the goods that they need or the goods and services that they want to buy. And overwhelmingly, they said, yes, they were concerned. And this is really linked to, it's a mix of what they think about their future income, but more importantly, what they think about prices.
Relatedly, you also asked consumers about whether or not they were putting away money or paying down debt or if they were having to borrow. to buy things that they need. What did consumers say about that? And was there any difference by income?
Yeah, so that's a very interesting question. So we ask consumers whether they have changed their kind of consumption and financial habits over the recent past, like the past few weeks. And over a third said that they have been saving money to be able to buy goods and services in the future. Over a quarter said they were using their savings to be able to buy goods and services. But when we look at difference by income groups, we saw that the lower income, most of them, they are using a mix of postponing purchases and using their savings to buy goods and services. When you turn to the higher income, they were the ones who were most likely to say that they were saving for the future, but also that they were advancing some of the purchases ahead of tariffs. We've been talking a lot about whether people were advancing purchases ahead of tariffs. It seems, according to a survey, that you only do it if you can afford to do it. You have consumers that are just going to replace their appliances once they break down because they don't have the financial means to be able to replace them whenever. So they wait until they break down. So those are not the ones who have been advancing the purchases. If you can afford it and you can replace your appliances whenever you want to, and you think that they're going to be costing 25 or 50% higher in the next few months, then if you have the means to do that, you may do that. But this is most likely something that's happening with the higher income groups.
Okay. Final question. So before May, we saw that consumers were indicating that they were pulling back on purchases of big ticket items, and it seems like they were a little less excited about buying services. Did any of that change in May given the softening in the administration's policies around tariffs?
Yeah, I mean, in line with consumer feeling less anxious about the future, being slightly more optimistic about future income. We saw also some increase in consumers' appetites to buy big ticket items going forward or to spend more on services. So indeed, there was some stronger appetite in May than there were in the past 2 months.
Thanks, Stephanie. Excellent conversation. So we're going to take a short break and we will be right back with more of our conversation.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. Again, I'm Dana Peterson, Chief Economist and Leader of the Economy Strategy and Finance Center at the Conference Board. Again, I am joined by Stephanie Guichard, Senior Economist of Global Indicators, and Erik Lundh, Senior Global Economist. So Erik, let's turn to you. So the Conference Board changed its forecast for the U.S. and global economies from April to May. Tell us why.
Dana, there's been a lot of developments over the last month or so, especially on the tariff front. When we originally published our April forecast, it was just after Liberation Day. We had an announcement on very high tariffs on a variety of economies around the world. There's a lot of uncertainty. And really what's happened over the last month is we've seen a pause on some of the tariffs that were implemented. We saw a big spike in China tariffs up to 145%, but those were negotiated back down to about 30%. It's been a bumpy month, and we've made some tweaks to our forecast accordingly.
What are our forecasts for the U.S. real GDP growth after the U.S. softened its tariff stance?
So we're currently forecasting that the US economy grows by about 1.6% for 2025 and about 1.5% for 2026. These are actually the same numbers that we were using last month, but the character of the growth rate has evolved a little bit over the last several weeks. We got a GDP printout for Q1. We had a negative 0.3% quarter on quarter read there. There was a lot of distortion in those data associated with imports and inventories. And as a function of that, we expect to see a bit of a pop for the Q2 GDP number as things normalize on the trade and inventory front. But looking into the second half of the year, we think that the growth rates are going to cool. We're still not forecasting a recession, but we think the consumer is going to potentially pull back a little bit and we'll see softer growth later in the year.
Okay. I also noticed that originally we had somewhat lower inflation in April relative to May and also a higher unemployment rate in April relative to May. So why don't you talk about why those forecasts changed?
Sure. So on the employment front, we continue to expect that we're going to see some softening on the labor market, maybe not quite as much as we did about a month ago. Some of this has to do with the fact that we continue to get pretty healthy job prints out, which one came out just a couple of weeks ago, which was unexpectedly strong. And we continue to think that the economy, as I mentioned, is going to slow, that the labor market is going to soften, and that we could see something around 4.6% unemployment at the end of the year. We continue to see a little bit of softening there. On the inflation front, the inflation forecast hasn't changed terribly. We're trending at about 2.3% for year-over-year PCE deflator. We think that's going to rise over the course of the next couple of months, and we'll get to somewhere in the low threes by the end of the year. So yeah, there have been some adjustments in terms of the unemployment and the inflation numbers, but they're not starkly different from where they were just a month ago.
Yes, I think it's also the fact that since April, we've also had a few new developments where the administration has floated maybe placing tariffs on Chinese ships, regardless of what they're bringing and where it's coming from, but any ships that come from China. And also, it used to be the case that any product that was imported into the US that was under $800
De
was
minimis,
tariff
yes.
free. And now it looks like that's going away. And that's so those two things are going to be additional sources of inflation. So that's why I think those numbers are moved up. And certainly with the unemployment forecast, you did mention that, yes, we're still seeing a pretty strong labor market. And I think that the US economy has a pretty strong labor market. If we do see layoffs, they may be mitigated a little bit by the fact that there's still some labor shortages in key industries. So given all this, what do our economists think the Fed will do now? I noticed that there was a change in the forecast.
That's when things start to get complicated for the Fed. As I mentioned, the tariffs. Let me back up a little bit. So when we entered 2025, we had expected the Fed to continue cutting. We had forecasted about 100 basis points worth of cuts to monetary policy over the course of this year. But that was before the tariffs were announced on April the 2nd, before some of the layoffs in the federal government were announced. And so there's a lot of things that have changed in recent months. We already outlined that we're expecting to see unemployment get a little bit higher, a softer labor market. We're expecting inflation to reaccelerate a little bit. And that puts the Fed in a bit of a bind because those two trends really constitute a more stagflationary environment. So for the time being, the Fed has been in a wait and see mode. It's been waiting to see hopefully inflation cool towards that 2% target. I think there's a little less confidence that it's going to do so as a function of the tariff implementation. But we think that the Fed's concerns about the economy overall and specifically about the labor market are going to overshadow its concerns about inflation later this year. And we're expecting to see 225 basis point cuts, really not until towards the end of the year. But that's a situation that the Fed finds itself in at present.
Thanks, Eric. So, how did changes in the US tariff stance from April to May affect the global forecast?
Also, an interesting question. We did maintain our global growth rates from April into May, but we did it based on some modeling work that we've been that we've been working on for several months now. So in April, we modeled the implications of the Liberation Day tariffs as they were presented at the press conference the other month into a large general equilibrium model that we run. And essentially, we saw the model suggests that we were going to see a 0.5 percentage point headwind to global growth for this year relative to our base case. We did expect at that time to see some progress on the tariffs. We thought we would see some negotiations, some pauses. And so we only incorporated about half of that headwind that was generated into our global forecast. We reran that exact same model using different numbers the other week, following the 90-day pause, finally following the de-escalation on China. And what that model suggested was a 0.3 percentage point headwind for overall GDP growth worldwide. But we incorporated more of that weakness than we did a month ago. And the reason for that is we think that there's maybe a little bit less uncertainty around the tariffs as they're currently presented. We don't expect to see necessarily large tariffs negotiated away. So we feel a little bit more confident that what we're seeing on the tariff front is going to be lasting. And so as a function of that, the global growth rates that we see for 2025 continue to be about 2.9% for this year, and then about 2.8% for 2026.
Okay, so it sounds like I was wrong at the beginning of our conversation. The US and global point estimates have not changed, but it's more about the composition. So just thinking about economies, did you make any notable changes in growth for
Sure.
any economies?
Yeah, we did. We saw, so as a function of some of the national accounts data that came out of Europe, specifically from Germany and Italy, they had a much stronger than anticipated Q1. And so as a function of that, it's levitated the full year growth rate for those two economies, which helped to improve the euro area a little bit. And then we saw upticks and downticks in some other smaller economies in Central Asia, for instance, as new GDP data came out. But it wasn't enough to move the needle really for the full global economy relative to where we were, again, for April.
Despite these changes, it still looks like the outlook is quite uncertain. So final question, what might cause further upgrades to the forecast, and what might prompt another downgrade?
So I think you're asking me two questions. This is a trick question, but
Sorry.
I'm happy to answer both. Tariffs continue to be front and center. We are watching developments. Just overnight, we had word that negotiations with Europe might accelerate, which could be a positive for our global forecast. Seeing resolutions on U.S.-Mexico strife, on U.S.-Canada, U.S.-China, these are all things that could benefit the global outlook. And the reverse remains true as well. Deteriorations are always possible. We saw a big deterioration with China a month ago that fortunately was reversed out. So tariffs are really upside and downside risk are seen in a variety of scenarios. One other thing that I might note before we go is the geopolitical front is something that we continue to watch really closely still. There's a lot happening in the Middle East, whether it's with Israel or Gaza or Iran, Eastern Europe, in terms of developments in terms of the Ukraine-Russia fighting. And then, of course, we had a bit of a flare-up in South Asia just a couple of weeks ago when Pakistan and India came to blows over some violence that occurred in Kashmir. So, unfortunately, these things, if they deteriorate, could certainly have regional implications, if not global implications for the economy.
Thank you, Erik. That was a great conversation. Thanks for being with me here today, Stephanie and Erik.
Great to be here.
Great to be here.
Excellent. And I also want to thank all of you for listening to C-Suite Perspectives. I'm Dana Peterson, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.